Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, and I'm recording this late Friday morning, as usual, on March 3rd. So, from a major indexes point of view, nothing too much has happened this week. As I record this, it's around 10:30, 11 in the morning. We're up about 1% on the week for the major indexes, maybe a little bit more, a little bit less, depending on what you're looking at. So the good news is we have kind of temporarily at least halted the 3-week slide that we've can't come in there. What I've been writing this week, really, when it comes to the evidence is, to this point, as opposed to last year, if we were a month into kind of a pullback last year, the evidence would be a mess, at best, if not really, really bad. This year, it's still technically positive, okay, but it's close. So it's kind of like the intermediate term trend is positive, but, a bad week from here could change that. Longer term moving averages, we're living above, but, it's not that much above. The broad market, to me, is still healthy, but, after 3+ weeks on the downside, we're starting to see new lows pick up a little bit, that sort of thing. So, me, I usually go with the evidence. So overall, I'm still leaning bullish, but, we'll see how it goes. Another couple things I'm going to touch on here in the video is defensive stocks are still kind of lagging even during the pullback. So again, a character change from last year. I'll show you that. And I think best of all, now this can change, not week to week, but it can change. But right now, I'm sorry, there's a lot of stocks and sectors that look to me like they want to go if the market lets them, okay? Now, I don't know if that means they want to go for 6 months or 9 months or if they want to go for 3 weeks. I don't know, but they look peppy, they look tight, they look like constructive, normal, grudging pullbacks as opposed to, not all of them, some of them gapped up and just kind of gave up the ghost. But, a lot of them have kind of pulled back, kind of like the NASDAQ, kind of like the major indexes where they have pulled back, but in a somewhat grudging fashion, despite the hike in rates and rate expectations and things like that. So I do think it's one of these situations where we're pretty close to key levels. If we have a bad week or two from here, it could be time to, not 90% cash, but to pare back. If we have a good week or two, though, I think there could be a lot of things that kick into gear, and it could be somewhat lucrative. As always, we'll just take it as it comes. Right now, in Cabot Growth Investors Model Portfolio, we're about 38% in cash, which I think is kind of a good area. So, we're pretty concentrated, so we can move quick. So if this rally, this bounce from Thursday and into Friday morning really kicks into gear, we could put some money to work real quick. But conversely, if we come in and there's more rate fears and stuff next week and the next week or two, maybe we have to pare back further. Okay, right now I'm more optimistic than not, to be sure, and I continue to lean bullish, but I'm not going to push it here until the market kind of shows its hand. Okay, all right, let's hop into the charts. We'll stick with MarketSmith this week. It's a product of Investors Business Daily. You can learn more at marketsmith.com. So let's look at the NASDAQ here. Again, you still have this pattern here where it's just multi-month bottom, rally. We're in an intermediate term uptrend. This orange line right here is the 50-day red line, whatever it is a 50-day simple moving average. And you still just kind of have this sort of, basically a bottoming pattern, a thrust higher above all moving averages, including long-term, and now a pullback. Now the pullback is not, it's not like this where it's very shallow, but it's a little deeper, but that's okay. We've gotten some people negative, but still okay and acceptable. And as we approached Thursday morning, really, the 50-day line, we found some support in the NASDAQ, okay? Now the NASDAQ, and I'm going to look at the IWM and the small caps and mid caps, right now are the strongest of the 5 major indexes that I follow closest, okay? Again, you kind of had this, multi-month bottom, a thrust above all moving averages, and then you have this tedious pullback, but again, kind of finding support, 50-day line, December highs, that sort of thing, okay? MDY, which is mid caps, you can just see it's actually looking better, same sort of pattern though overall recently, okay? Now some of the other stuff is a little sloppier, so like the S&P 500, same general pattern, but you can just see a little bit deeper in here, a little bit below the 50-day line, although it's popping back above it yesterday and so far this morning. We'll see what it closes. And the New York Composite. I just run through these indexes. I have this like preset actually on stockcharts.com, but whether it's MarketSmith or stock charts, I just run through these every morning or every couple of days just to, ground yourself kind of when you wake up in the morning and don't be biased by what happened yesterday, okay? So the intermediate term trend, what I'm trying to say is the intermediate term trend is up, but it's not so much like, there's not much daylight, so to speak, where, well, we could just really fall down here and still be okay. No, if we did that, I'm not saying we're going to fall 20%, but that would be a little bit more in the, okay, the intermediate term trend may be broken camp and we have to, fight through this Fed uncertainty for a while longer, okay? But so far, so good on that. The other thing just to point out, and I sort of mentioned this with the NASDAQ, but again, we're above longer term moving averages. So this is the NASDAQ, but here's the S&P kind of right at the 200-day line, but held it. This is the spiders, small cap, mid cap, just another, again, you're not have a ton of daylight there, but still holding above that. Okay. So that's pretty good. The other thing too is, so I get this going, I just find it interesting where it did bounce yesterday, but I continue to watch this XLP and, there's interest rates, there's the dollar, there's other factors there, but I still think this is just like the ultimate defensive stock index. And, you saw it last year, you had rising interest rates for a lot of times last year. It didn't stop, this index from kind of leading the way at certain points in time. And right now you kind of see like I said last week, it kind of outperformed a little bit by just not going down as much, but this week it actually is down. I mean, I'll tell you right now, the XLP as I record this, it's down 0.8% on the week, and the spiders are up 1.2% on the week, So that's kind of the dynamic we're still seeing. XLU is more, I think it's more interest rate sensitive because not just the stocks, but the companies have to borrow a lot of money and stuff like that. But again, you're kind of seeing underperformance among some of the defensive stuff. We'll see how it plays out, but so far I definitely consider that to be a positive, especially when you look at other areas like I keep mentioning chip stocks. This is stronger than the NASDAQ, stronger than the major indexes. You can see this does have some daylight above the 50-day line. And, if you kind of look at the December highs, just ballpark, it's not miles above it, but it looks better than the major indexes is what I'm trying to say. XLK, I'm not a big fan of this because this is kind of big cap weighted, but again, it just looks a lot better than XLP, you know what I mean, in something like that. So I find that kind of interesting on the sector front. I do find that encouraging. I'm not saying, if the S&P is down 2% next week, but XLP is down 3%, I'll be happy. No, because then maybe we're breaking intermediate term trends and stuff. But so far, I definitely think that's a subtle, under the surface, encouraging sign, I guess, that it's not like people are rushing into defensive stuff and anticipating some huge decline. Another small thing, again, we're getting into secondary, tertiary stuff. To me, the main thing is the market's trends have so far held, the evidence is so far held, the primary evidence sort of thing. But I do find it interesting. This is IYT, which is basically the Dow Transports. I could probably, same chart. And similar sort of thing. It's a little sloppier. It's an ETF, not that well traded, so I'm not recommending this or anything, but kind of held the 50-day line here. And it's just, it's a little bit, I'm seeing a lot of these, again, you thrust, you pulled back, and now you're kind of bouncing off support. And if this can kind of, big if, but if this can kind of resume, it does kind of look like a little bit of a pullback resumption. So we'll see how it goes. But of course, transports are, in the economic, I don't want to say firing range, but that's what investors are focused on here. So this could be a sign that some of the economic worries kind of waning and then coming back on. So far, it looks like they may be waning here in recent days. So overall evidence more positive than not. I'm encouraged. Some under the surface positives when you're looking at top down stuff, sectors and indexes, and the broad market. But it's close, and you got to respect it. So if we do come in and the Fed just obliterates us with 10 speakers next week or whatever, all saying that rates have to go to 1,000,000%. You have to respect that and just know it's possible. But so far, the market's been able to absorb a lot of that, especially when you consider the size of the move. I was talking about this the other day, not to go on a tangent, but since this is basically February 2nd, I think, right here. So call it 3.4%. So the 10-year note's gone from 3.4 to, as of yesterday, almost 4.1. So almost 0.75%, 0.7. It's down a little bit today, but 2/3 to 0.75% in basically a month. And pretty straight up like this, And the market has pulled back, of course, but it's not disintegrating. Again, I just view that as a small, I wouldn't buy because of that, but it's a small encouraging thing that's in the back of my head saying, like, if the market wanted to keel over right now, it easily could have. And if it was last year, I think it would have. But it's definitely putting up more of a fight for sure, okay? The other thing, too, is just individual stocks. I'm actually seeing more breakouts. Granted, there's earnings related, but I'm seeing like more stocks look good now than maybe 2 or 3 weeks ago. We'll see how it goes. But let's just start running through this list. I've mentioned AXON before, AXON, reported earnings. This day actually was the day before earnings. It was last day of the month or whatever. So maybe there's some stuff that happened there. But either way, not the biggest gap of all time, but clearly out above, round number resistance here, 200. Same thing with the weekly chart. And because the index, one thing that's interesting is because of the, we look at these RP lines, or we call them RP, relative performance, relative strength lines, whatever you want to look at, call them. I mean, because the S&P is still whatever below, 418, here it is at 402 or whatever. Because it's still well below its recent high from a month ago or 5 weeks ago, a lot of these stocks that are perking up, you can see the RP line is really spiking here to new highs, okay, which is usually a constructive sign. Anyway, AXON looks good, good volume, good buying, holding it so far. Could it fail? Obviously, yes. But again, I always say this every week. You want to go with what's in front of you, okay? Some airlines look sloppy. United Airlines, I'm sorry. Again, there's no surety in the market. And if you're looking for that, go buy, 6-month treasuries or whatever. But this is sort of a classic sort of bottoming cup with handle thing, if that's what you want to call it. It breaks out, and then the market's not ready. So what happens? It forms a very tight flat base. This is all, if you're interested in this stuff, very tight flat base in here. You can see a couple weeks ago, you can barely even see that dot, blow up that screen. Very well controlled. Okay, now it's an airline stock. I'm not going to sit here and tell you that the thing is going to quadruple overnight, but UAL looks good. It's a little bit, some other names don't look as good, so maybe the group needs a little bit more time, but overall, it's a pretty nice pattern. Speaking of other things not looking as good, so solar is very mixed. There's a couple names that look okay. First Solar has been the leader the whole time, as it turns out, and this is something of a ascending base. You kind of have 3 pullbacks over a few months, higher highs, higher lows, and then it kind of lets loose on the upside. Usually this happens kind of later in advance, and it can run, but we'll see. Either way, just taking it for what it's worth. It's a big high volume breakout. You can see the volume this week. It's not going to be as big as a couple months ago, but it's one of the biggest here going back. I don't know, this chart goes back 3 years. Okay, so 3+ years, 3.5 years. So looks like that's under control. Shift 4. This was our worst, just for full disclosure. This was our worst looking stock here. Not terrible, but worst looking. We had a small loss. We had a full position. Earnings were coming out. The market was iffy. This is earlier this week. So we sold a piece just to take let some steam out. But I have to say the reaction has been awesome on earnings. Estimates are up. Estimates are great. The story's great. And not just one day, but 2 big days on earnings. And it's looking like, I think this day was the biggest volume day since, I want to say, November 2021. And you're going to see on the weekly chart, it's still got this sort of old, we'll see what happens with the market, but it's certainly heavy volume. It certainly looks right. Again, with a new RP peak here because it's kind of running ahead of the market. So with all these, you can't rule out another, if the market's iffy, you can't rule out another shake and bake where this thing's down a few percent, but it certainly looks like it's ready to go. And this looks like a good, shakeout, of course, before that. Okay. Old Dominion. This is trucks, you know what I mean? So I've had airlines, solar, trucks, and guns or whatever, AXON, cloud, I guess. But Old Dominion, just again, with this sort of pattern, we're seeing more. This is sort of still in a big structure, but you have a few clues here. You have 5 weeks up in a row, including a big reaction to earnings. Gets right back up to its old price high, but notice how relative to the market, it's a new high. And then on the daily chart, this is what it's hard to say grudging. If you owned it, you didn't feel grudging. It felt like it went down every day. But if you look at a chart, it just felt like it kind of filled the gap and just kind of hung in there. Volume wasn't really much of anything. And then I'm not saying yesterday's volume was the be all end all, but a nice move there. So we'll see. It's down today again with the transports. That's kind of what made me think of it. But overall, that there's a few stocks like this that look pretty good. Palo Alto Networks, PANW. What's interesting today is Zscaler, ZS is getting, this is down 10% on earnings. Whatever. It hasn't looked that good, but it's not, if they wanted to use that as an excuse to nail Palo Alto Networks, they could, but it hasn't. And this one's been sort of more resilient than the group for a while. It's almost kind of a big double bottom thing here, and now it's racing higher. You can see the volume on earnings last week, and really just this week it's just very tight and well controlled on the weekly or the daily chart. So that one looks pretty good. Maybe it chills out for a while. It would be great to get the cybersecurity group going, but so far it's a little bit of a lone ranger. Sarepta, SRPT. I think I mentioned this, how it's just kind of a nice base on base. That doesn't mean it's going to gap on earnings. It could have gapped down on earnings. You don't know. Excuse me. But they had good numbers, and it looks like their new drug is on its way. Even today, I think they had something of a convertible share buyback, so to speak, which diluted the share count, but the stock opened down but quickly went back up. So that looks pretty good. And you can see on the weekly chart back here, there's some old stuff back here, but at this point, this is 2+ years ago. I'm not too worried about it. That looks good. There's a ton of names here. ACLS was one name that, so Tesla's said they might not use as much silicon carbide. I don't want to give too much away here, but you can just see this was wild at the open, came all the way down pretty much to the 50-day line, but then they bought it all back up and now it closed here. Now, sometimes these things will, quote unquote, it's called eating the tail. It's not a chart pattern. It's just something they say. So I wouldn't be surprised if it took a little bit more of a break and digests and they get a little bit more clarity on what's going on, but certainly a big sign of support on the daily and even the weekly chart. You can see the 10-week line test found support. Hyatt, kind of I don't want to say it's a cousin to United Airlines, but another travel name. Had some wobbles here before earnings, but again, you just step back. It didn't even get, or it only got to the 25-day moving average, which is this green line, and then racing to new price highs and RP line highs. Could pull back, but looks good. Avago, I'm just mentioning this as a chip stock, or not Avago, Broadcom, gapping up here on earnings. This is not a fastest horse. It's a $600 stock. But again, it's just another big chip stock, whatever, $250 billion market cap. That's acting well. NVIDIA, of course, I think I mentioned this last week. We'll see. Let's see. It's down now, but it's down 30 cents. First of all, again, very, very, very tight and low volatility this week. No desire to sell it really to this point. And we'll see. It might end up being up 9 weeks in a row instead of just 8. Either way, I think the stock looks pretty good. I wouldn't hate it if the stock kind of chilled out for a bit, maybe pulled back a little bit, but certainly acting well. And then you just kind of go all through it. This is Morgan Stanley. It's not my kind of thing, but you can just see since the, excuse me, I got a frog in my throat. This is the October market low. This is the December sort of pre-ramp in January. Had a wobble. That was that bad quote day, so ignore that. But again, kind of dipped here steadily, not very fun to live through, but very light volume. Hits the 50-day line and bounces. We'll see what happens. Stifel Financials, kind of more of a bull market stock. Again, you kind of have these lows, the thrust here, and then just very tight. Just a lot of stocks acting properly. And then a couple of, here's one big cap name. This is Meta, Facebook. I'm looking for fresher merchandise. But I will say, again, you kind of have this bounce, and then you have this huge ramp, of course, on earnings. Estimates way back up. Not that they're growing that fast anymore, but still pretty good. And maybe those estimates are low. And again, you kind of get this tedious pullback here, but just to the 25-day line, you can just kind of see how I don't want to say tightens up, but there's not a lot of movement there. It's not up and down 10 points a day and everyone's talking about it. Instead, it's just kind of coming in there nice and tight. Everyone's focused in on whatever the hell's moving or the Fed speech or whatever, and they're buying it, and now it's popping a little bit on the upside. Not something my favorite, but I'm just pointing that out as a mega cap name that's acting pretty well. And then last but not least, I just want to mention there are some steel stocks tend to be doing pretty well here. RS looks like one of the leaders. Again, it's a $260 stock, but it broke out nicely a few weeks ago and really just been stair-stepping its way higher. I think volume this week was more, end of the month sort of thing. So I would ignore that. But Steel Dynamics kind of confirming it. I think I mentioned this last week how, it pulled back sharply, but it's kind of above the 50-day line. And then boom, you can just see, smoke up a chimney here. So again, you got steel, airlines, hotels, cybersecurity, payments, there's more, solar, there's a variety of things that are looking pretty good. Now, don't get me wrong, maybe by today's close, the market's down here, or, by next Tuesday, it's down here because the Fed comes out and, fires a bazooka at the market or something like that. But I will say that there's been a lot of hawkish talk. There's been a lot of, higher interest rates. There's been a lot of that sort of thing going on. And so far the market has pulled back normally. I would say we're not in abnormal territory on the pullback. I think a lot of stocks were definitely not in abnormal territory. We're in kind of territory where it's like you want to buy them. You just don't want to be, you don't want to get caught if the market pulls back. So I would be, I wouldn't be heavily defensive here. I wouldn't be fully invested either. I kind of like where the model portfolio is at. Like I said, 38% cash, that sort of thing. And let's just watch. I think in the next week or two, we'll get an answer. Maybe we just chop sideways, but I think if we can really start resuming on the upside, not only will the market look better, we're going to get more and more names that are popping out here that have set up here in the past month or 5 weeks. Okay, obviously, if the opposite occurs, we're going to see some of these things that are strong right now pull back. Some things that haven't bounced might crack, that sort of thing. So I'm definitely more optimistic than not, but I think it's best just to, assuming you've done some buying and have some stocks that look decent, to kind of chill out here and just let the market tell you what it's going to do. If we're going to go up, it's not going to end in a week or two. You're not going to miss it. I think it could go on for a long time. So you don't want to rush it. You just want to kind of honor the stops, follow the evidence. Right now, that means more bullish than not, but also keeping a close eye on things too. Okay, that's all the time I have for today. As always, thanks for listening, and come by again next week for another Cabot Weekly Review.